Ethereum's next growth spurt came in 2017, propelled by surging interest, new use cases, and yes, rampant speculation. So in early 2017, that period saw the formation of the EEA, which is the Enterprise Ethereum Alliance, a consortium of major companies and startups exploring Ethereum for business applications. Then by mid 2017, the EEA had hundreds of members, including Microsoft, Intel, JP Morgan, and a lot of other people. And that signaled serious institutional curiosity about Ethereum's technology. But the true driver of Ethereum's 2017 explosion was an entirely new fundraising phenomenon built on top of smart contracts: the ICO boom. A lot of projects realized they could raise capital by issuing their own tokens on Ethereum, and they often use the simple ERC20 token standard introduced in 2015. And that's what I was doing back in 2015 too, like using ERC20 standard when I was like experimenting with like a test networks. And they sold those tokens to the public in exchange for Ethereum. In effect, Ethereum turned into a global crowdfunding platform. During 2017 alone, over $5.6 billion was raised through ICO token sales on Ethereum. It seemed that every week a new project launched a token for some proposed decentralized app or service, and investors, big and small, rushed to buy in hopes of future gains. This sudden gold rush of ICOs drove an unprecedented surge of on chain activity. Ethereum's price skyrocketed from under $10 at the start of the year to over $800 by year's end amid the feeding frenzy. For the first time, the Ethereum network was operating under heavy real world economic load, and cracks were beginning to show. Transaction volumes multiplied, network congestion became a persistent issue, and gas fees, which is the price to process a transaction, began creeping upward as users outbid each other to get their operations mined. This was a double edged sword. On one hand, it proved substantial demand for Ethereum's capabilities. On the other, it stressed the current protocol to its limits, highlighting the platform's notorious scalability problem. A vivid illustration of these limits came in late 2017 with CryptoKitties, a whimsical decentralized application for buying, breeding, and trading unique digital cats, and they were represented as non fungible tokens, aka NFTs. CryptoKitties went viral in December 2017, and though it was a trivial game, its popularity clogged Ethereum's capacity. Transactions slowed to a crawl, many users saw their transactions pending for long periods, and gas prices spiked so high that the cost of breeding a virtual cat sometimes exceeded $100. CryptoKitties demonstrated in a very public way that Ethereum could not yet scale to meet global demand. A single popular dApp was enough to saturate the base layer. This reality check lit a fire under Ethereum's developer community. Scalability, which had always been on the roadmap, became an urgent priority. Rather than immediately redesigning Ethereum from scratch, the community pursued a multi-pronged response to the 2017 scaling crisis. So I have that up over here somewhere. Let's see. Yep. In the short term, infrastructure improvements and optimizations helped somewhat. For example, the Byzantine upgrade in October 2017 added some efficiency tweaks and lowered gas costs for certain operations. And then new tools like Infra, which is the hosted node service, sprang up, which allowed decentralized application developers to access the blockchain without running their own node, which offloaded some demand. Block explorers like Etherscan evolved into full featured analytics platforms to better monitor the increasingly busy network. And crucially, professional security auditing became the norm, as mentioned, to ensure new smart contracts, especially the ICOs holding millions in Ethereum, would not repeat the DAO's mistakes. But technical stopgaps were not enough. The writing was on the wall that Ethereum's original design, a single chain processing every transaction, would eventually need a more dramatic overhaul to scale. Thus, in parallel, research into layer 2 scaling and protocol improvements accelerated. Vitalik Buterin and others proposed frameworks like Plasma in August 2017, which was a method for creating off-chain child chains that periodically report back to the main chain. Others worked on state channels, which was inspired by Bitcoin's Lightning Network idea, with projects like Raiden aiming to move frequent transactions off-chain except for occasional settlement. And then sharding, a concept of splitting the blockchain's data and transaction processing across many parallel subchains, went from a theoretical idea to a formal research topic documented on Ethereum's research forums and roadmap by 2018. And notably, an idea called rollups began to gain traction after Vitalik highlighted their potential in 2018. Rollups would involve bundling large batches of transactions off-chain and then submitting a compressed proof of summary to the main chain, thereby multiplying output. Early prototypes of optimistic rollups and ZK rollups were explored by startups and academic teams. Though these would not be ready for production until a few years later, by the end of 2018, Ethereum's core developers had sketched out a long-term plan informally called Ethereum 2.0, or Serenity in older parlance, a transaction the network to a vastly to transition the network to a vastly more scalable architecture. The plan centered on two major changes: shifting from proof of work to proof of stake for consensus, and implementing sharding to split the load of transaction processing across potentially dozens of chains. This was an enormous undertaking, akin to swapping the engine of an airplane mid-flight, and it would take years to materialize. In the interim, Ethereum had to keep running and improving incrementally. The good news was that despite the 2018 crypto market crash, when Ethereum's price fell over 90% from its peak, mirroring Bitcoin's decline, the developer momentum on Ethereum remained strong. Many ICO-funded projects fizzled out, but others pivoted and continued building real products. The concept of DeFi, decentralized finance, quietly germinated during this time, with protocols like MakerDAO launching a stablecoin in late 2017. Ethereum itself underwent steady upgrades. The Constantinople hard fork in early 2019 brought efficiency improvements like cheaper storage operations, and later, Istanbul in December 2019 introduced further optimizations. A new and those further optimizations were a new cryptographic primitives to support advanced applications like the privacy-preserving zero-knowledge proofs. Each upgrade also delayed Ethereum's built-in difficulty bomb, a feature originally planted in the protocol to exponentially increase mining difficulty and freeze the chain if proof of stake did not arrive in time. Indeed, throughout 2017 and 2019, the core developers repeatedly diffused this ticking time bomb in Byzantine, Constantinople, and beyond to give the network more breathing room. The difficulty bomb was a nudge towards the future, ensuring the community would not forget the necessity of the proof-of-stake transition. But it had to be managed carefully so as not to degrade the user experience before the new system was ready. By pushing the bomb forward, Ethereum's leaders signaled yes, proof-of-stake and sharding are coming, but not at the expense of today's stability. And so, Ethereum entered 2020 battle-tested by mania and misadventure with a more robust infrastructure and a clear, if daunting, roadmap to the future. 2020 proved to be a pivotal year that showcased Ethereum's real-world utility beyond speculative token sales. This was the year of the decentralized finance explosion. A new wave of Ethereum-based protocols for lending, borrowing, trading, and asset management captured the imagination of crypto enthusiasts and technologists alike. Unlike the one-off ICO sales of 2017, decentralized finance, decentralized applications generated continuous on-chain activity. People supplied assets to liquidity pools, traded tokens on decentralized exchanges, took out collateralized loans, and earned yields through complex strategy vaults. Platforms like Uniswap, which is an automated exchange for tokens, saw cumulative volumes in the billions of dollars, and lending platforms like Compound and Aave accrued tens of thousands of users and billions in deposited assets. By November 2021, the total value locked in DeFi smart contracts exceeded $100 billion, having been under $1 billion at the start of 2020, a staggering growth that signaled a shift from pure speculation to functional financial utility on Ethereum. This period, often called decentralized finance summer, DeFi summer, referring to the mid-2020 when activity really took off, demonstrated the power of Ethereum's composability. Different applications could interact with each other permissionlessly, allowing complex financial products to be built like Lego bricks. However, this surge in use had a familiar consequence. Ethereum's throughput and fee issues returned with a vengeance. As users raced to capitalize on yield farming opportunities, where one might execute a flurry of trades, loans, and token swaps to maximize returns, the network frequently operated at full capacity. Transaction fees, gas prices soared, at times pricing out all but the largest players. It was not uncommon in mid-2020 to see routine transaction fees of $10, $50, even over $100 during peak congestion. This was unsustainable for a network aspiring to serve all of humanity. But the critical difference in 2020 was that Layer 2 scaling solutions were finally becoming reality. Years of research began to pay off. Optimistic rollups and ZK rollups launched in prototype or beta forms on mainnet by 2021. Optimism and Arbitrum, two optimistic rollup networks, went live and quickly attracted users and capital. Within months, each had onboarded over 1 million users looking for faster, cheaper transactions anchored to Ethereum. These layer 2 networks executed transactions off-chain but posted compressed proofs to Ethereum, relying on Ethereum for security. So they demonstrated up to an order of magnitude lower fees for users, easing some pressure on the main chain. And then similarly, Starkware and ZK Sync pushed forward with zero knowledge rollups for payments and trading, and they achieved massive scalability gains with the strong security of math proofs. Then by late 2021, it was evident that Ethereum was evolving from a single chain ecosystem into a multi-layered one. The base layer, which is layer 1, was increasingly viewed as a settlement and security layer, handling the most important transactions and checkpoints, while the bulk of user activity could occur on layer 2 networks that periodically settled back to layer 1. Ethereum's ethos had subtly shifted. Rather than one computer for the whole world doing everything, it became one secure base layer for the world, plus many connected networks handling the bulk of execution. This modular approach was quickly becoming accepted as the pragmatic path forward. Meanwhile, Ethereum's long-awaited transition to proof of stake was drawing near. The first step of that transition launched on December 1st, 2020 with the Beacon chain, which is a brand new proof of stake blockchain running in parallel to the main Ethereum chain. The Beacon chain was phase 0 of the Ethereum 2.0 plan. It established a live network of proof of stake validators who would for a time simply practice running the consensus mechanism without handling user transactions from Ethereum. To join, participants had to stake 32 Ethereum, locking it up in a one-way deposit contract on Ethereum 1.0 and run validator software. The Beacon's chain launch was a success, gathering the minimum required 16,384 validators and more over time. But for nearly 2 years, it existed in isolation, a sort of proof-of-stake testnet with real money at stake, but not yet merged with Ethereum's main economy. This cautious approach allowed the proof-of-stake system nicknamed Casper during development to prove itself and harden without endangering the running network. Validators on Beacon Chain produced blocks in 12-second slots, voted on the chain's finality, and experienced new slashing penalties for any misbehavior, ensuring honest participation. All the while, Ethereum's proof-of-work chain kept chugging along. Periodically delayed difficulty bombs aside, by early 2022, confidence was high that the proof-of-stake system was stable and the moment was approaching to perform the merge. That is, to fuse the two chains so that Ethereum's ledger would henceforth be secured by the Beacon chain's proof-of-stake consensus and mining would be turned off forever. The merge, as it came to be called, was arguably the most anticipated and complex upgrade in Ethereum's history. For years, skeptics questioned whether switching a live $100 billion network to new consensus mechanism was even possible. On 15 September 2022, Ethereum answered that question with a resounding yes. At block number 1553739 the network underwent the merge. The running proof-of-work chain had hot-swapped its consensus to proof-of-stake Beacon chain, triggered by a preset total difficulty threshold. In that moment, mining on Ethereum ceased and validators took over block production entirely. The merge was composed of two parts: a preparation upgrade called Bellatrix, which readied the Beacon chain and introduced rules like validator slashing on the consensus side, and then the execution of the merge itself, called Paris, which occurred at the specific block and linked chains. So astonishingly, this all happened with no downtime for Ethereum users. The chain continued producing blocks, and outside of a brief hiccup or two, everything kept running as normal. It was as if a spacecraft swapped out its engine mid-flight and nobody on board felt a jolt. The technical achievement of merging a live blockchain's consensus layer on the fly after years of proof-of-work operation was unprecedented. Immediately, the benefits became clear. Ethereum's energy consumption dropped by an estimated 99.95% since the electricity-hungry mining process was eliminated. This answered one of the sharpest criticisms levied at Ethereum and crypto more broadly regarding environmental impact. No longer were thousands of GPUs and ASICs burning power to secure the network. Instead, security came from stake. Economic value pledged by validators would be penalized, slashed if they misbehaved. By the time of the merge, over 400,000 validators were active, collectively staking more than 13 million Ethereum worth tens of billions of dollars to back Ethereum security. This wide distribution of validators made attacks exceedingly expensive. One would need to acquire and risk a huge amount of Ethereum to even attempt to compromise the chain. The network continued to finalize blocks through a new mechanism every 32-slot epoch. Validators attest to blocks, and once enough attestations are gathered, the chain is considered final, irreversible by Casper's rules. Thus, Ethereum's consensus became both greener and, in many respects, more secure against certain attacks, since finality and economic penalties raised the cost of reorganization attacks dramatically. Furthermore, the merge introduced a formal separation between Ethereum's execution layer, the EVM, and transaction processing, and its consensus layer, the beacon chain driving block consensus. This modularization was intentional. It paves the way for future upgrades like sharding by allowing consensus to be upgraded somewhat independently of execution. In the immediate wake of the merge, a palpable sense of relief and triumph washed over the Ethereum community. Many core developers had poured years of research, testing, and fine-tuning into this event. Its success significantly increased institutional confidence in Ethereum. Indeed, a network that can seamlessly reinvent its core engine in real time proved its adaptability. Even some previous skeptics began to acknowledge Ethereum's technical prowess. Regulators and mainstream companies, long wary of crypto's carbon footprint, took note of Ethereum's dramatic improvement in energy efficiency. In summary, the merge was not just a technical pivot, it was a cultural one. Ethereum definitively showed it could evolve in fundamental ways while still upholding its values and continuity. And with proof of stake in place, the stage was set for the next leaps in the Ethereum roadmap. So then there's the post-merge, and that started in about 2022, so around September 15th. So in the post-merge, Ethereum's focus shifted squarely back to scalability and modularity. Having solved for now the consensus dilemma, attention turned to making Ethereum more usable at scale and cheaper for everyday transactions. Ethereum's roadmap was often described by Vitalik in terms of several surges or themes like the merge, which is now done, the surge, scaling via rollups and sharding, the verge, which is vertical trees and state efficiency, the purge, which is eliminating historical baggage and minimizing node storage requirements, and the splurge, which is miscellaneous improvements. In 2023 and 2024, significant progress was made, particularly on the surge. So Ethereum's core developers and research teams doubled down on a rollup-centric roadmap, essentially acknowledging that Layer 2 rollups would handle most transaction throughput, while Layer 1 would optimize to support those rollups. By late 2024, rollups had become the primary execution environment for many users. Popular consumer applications from games to social platforms started launching directly on Layer 2 networks rather than the Layer 1 mainnet, to take advantage of lower fees and higher speed. For instance, Base, and a Layer 2 network built using optimistic rollup tech and released by Coinbase, attracted a large user base in 2024. Meanwhile, ZK rollups matured. Projects like ZK Sync, Starknet, and others achieved fully programmable EVM-compatible rollups, meaning one could deploy the same smart contracts on Layer 2 with the security of Ethereum's proofs. This proliferation of Layer 2s led to a landscape where the aggregate throughput of Ethereum, if you count all the Layer 2 activity, grew exponentially. Even while the base layer remained constrained to 15 million gas per block, but to supercharge rollups, Ethereum Layer 1 itself implemented an important upgrade in late 2023, proto-dank sharding, delivered in the network upgrade known as Denken, which is a combination of Deneb and Dankun. The consensus execution layer code names. This upgrade activated in March 2024. And then it introduced EIP 4844, which added a new transaction type carrying larger blobs of arbitrary data stored temporarily by Ethereum at a minimal cost. These blob transactions are much cheaper than regular call data for rollups to use because the data is not permanently kept in the state. It's pruned after a period but available long enough for rollups to ensure data availability. In effect, EIP 4844 slashed the cost for rollups to post their batch transaction data to Ethereum by an order of magnitude. Early measurements showed 98% reductions in Layer 2 fees for users when rollups adopted blob posting. This was a game changer. Suddenly, many rollup transactions like swapping tokens or minting NFTs on a Layer 2 only cost a few cents again, even when the main chain was congested. The result was a surge in Layer 2 adoption in 2024. Networks like Base and zk-Sync each crossed over a million active addresses. Users who had been priced out of Ethereum Layer 1 found refuge in these Layer 2s while still benefiting from Ethereum security guarantees. It became common to see daily transaction counts on the combined Layer 2s far exceeding those on Layer 1, a clear sign that the modular scaling strategy was working. Ethereum itself was becoming more modular and extensible in ways beyond just rollups. A concept called restaking emerged, led by a project named EigenLayer, which allowed Ethereum's existing validators to restake their ETH to secure new auxiliary networks or services. In traditional terms, Ethereum became the base trust layer not only for rollup transactions, but for other functions like data availability, layers, and Oracle networks. Instead of new networks bootstrapping their own validator set and token, they could piggyback on Ethereum security by having Ethereum validators opt in to secure them, with slashing conditions extending to those services. By late 2024, this concept gained serious traction. EigenLayer had over $12 billion in Ethereum restaked to various emerging services. More than 130 active validated services were in development or testing, which range from data availability chains like EigenDA for offloading data from rollups to decentralized sequencers for coordinating rollup ordering to novel Oracle and compute services. The idea of Ethereum as a trust subnet took hold. Ethereum was no longer just a single blockchain, but the center of a hub and spoke model of many chains and services, all anchored in its economic security. And then by 2025, this transformation was unmistakable. Ethereum's modular architecture was not theoretical, it was reality. We saw the rise of application-specific Layer 3s, essentially rollups on top of rollups. Some projects chose to deploy their own dedicated rollup to tailor the environment to their needs. For example, a gaming studio might launch a custom WASM-based rollup for high-speed game transactions, settling onto a Layer 2 or Layer 1. And then major DeFi protocols like Uniswap and Aave even discussed launching bespoke rollups to optimize how their transactions are handled, which reduced MEV extraction and then it improved cross-rollup liquidity. Ethereum's ecosystem now spans Layer 1, Layer 2, and Layer 3, with value and activity distributed across these layers. This posed new challenges in governance and coordination, how to manage systems where decisions and upgrades might need to account for multiple layers. Early experiments began in cross-domain governance. For instance, enabling token holders to vote on proposals that affect both a Layer 1 protocol and its Layer 2 deployments. There was exploration into using ZK proofs for off-chain governance to prove voting results without revealing everything, hinting at a future where even governance processes leverage the advanced cryptography Ethereum enabled. So, amidst this whirlwind of innovation, Ethereum continued to undergo regular upgrades to refine its core protocol, and then in April 2023, we had the Shanghai Chapella upgrade. That upgrade finally enabled withdrawals of staked Ethereum from the beacon chain, which was a crucial functionality. Until then, validated 32E stakes have been locked since launch. Shanghai's success meant that participants could now unstake if desired, adding flexibility and reducing the perceived risk of locking up funds. Notably, fears of a mass unstaking, which some thought could flood the market with Ethereum, did not materialize. While some validators did cash out rewards or exit, even more new validators joined, and the total amount of Ethereum staked continued to climb after Shanghai. By 2025, roughly 30% of all Ethereum circulation was locked up in staking contracts, a testament to network participants' confidence and attractive yields from validation. From validation, we're getting yields, baby. The London upgrade back in August 2021 had already overhauled Ethereum's fee mechanism by implementing EIP 1559, introducing a base fee that gets burned, destroyed in each transaction. This change not only made transaction fees more predictable for users, but also had a profound economic effect. During periods of high demand, Ethereum now burns more Ethereum in fees than it issues to validators, making it deflationary at times. Indeed, after the merge, drastically cut new Ethereum issuance since proof of stake requires far fewer rewards than proof of work did. Ethereum's monetary policy turned ultrasound. By 2023 to 2024, the total Ethereum supply had peaked and even begun declining slowly as usage continued and fees were burned. In combination, proof of stake Plus, EIP 1559 made Ethereum transition to a low inflation or even deflationary asset, strengthening the economic incentives for people to hold Ethereum long term. So I'm just gonna look up EIP 1559 so we could talk about it real quick. So Coinbase. So the Ethereum Improvement Proposal 1559 is an upgrade that happened on August 5th, 2021 to change how Ethereum calculates and processes network transaction fees, called gas fees. We know that. The upgrade made Ethereum transactions more efficient by using a system of block-based fees and sender-specific max fees rather than bidding on gas prices to more evenly incentivize miners in periods of high or low network congestion. It was packaged with the London hard fork. 4 other EIPs will join EIP 1559 in London. How does EIP 1559 affect me? If you're trading Ethereum tokens on Coinbase, it will not affect your transactions. If you're attempting to process transactions directly on the Ethereum network, EIP 1559 will change the way the Ethereum network calculates and processes network fee. Okay, so we're getting lower fees. Great. Other upgrades. So now let's go back to my timeline that I got from lampros.tech. Shout out to them with the history of Ethereum. All right, so other upgrades in 2024 and 2025, such as the Pectra upgrade in May 2025, brought further refinements. Pectra, a portmanteau of Prague and Electra, which is a combination, it's 2 parts, introduced improvements for validators and developers alike. EIP 7251 raised the cap on how much a single validator can stake from the fixed 32 Ethereum as a high of 2,048 Ethereum, enabling larger stakers, like institutions or staking pools, to consolidate some operations if desired. And EIP 7702, sometimes dubbed a step towards account abstraction, allowed externally owned accounts, the normal user accounts controlled by private keys, to directly use certain smart contract functionality. This blurred the lines between user wallets and smart contracts, opening the door to more flexible smart wallets that could, for example, initiate multi-sig approvals or session keys without needing bespoke contract accounts. In fact, even outside protocol changes, the concept of account abstraction had been gaining ground. By 2025, many user wallets supported features like paying gas with ERC20 tokens or batching multiple actions in one transaction, thanks to on-chain infrastructure like ERC4337, which achieved some account abstraction at the application layer. All these developments point to a better user experience, making Ethereum easier to use for the next billion users who might not even realize they're interacting with a blockchain. Throughout this period, regulatory and institutional dynamics also evolved around Ethereum. In the aftermath of the ICO boom, regulators like the US SEC started cracking down on unregistered securities offerings. Numerous ICO projects faced lines or orders to refund investors. Ethereum itself, however, got a notable reprieve. In June 2018, an SEC director, William Hinman, stated in a speech that Ether was not considered security, largely because the network was sufficiently decentralized and no central party was expecting profits from managerial efforts. This stance, later tacitly upheld by the SEC and CFTC, gave Ethereum room to grow without the immediate threat of being regulated like a stock or bond. In fact, the CFTC chairman by 2019 openly called Ethereum a commodity, akin to Bitcoin cementing its status. Around the world, Ethereum was generally treated as a digital asset or utility, not a company share, so a critical distinction that allowed open innovation. That said, as Ethereum enabled whole new financial markets like DeFi, stablecoins, NFTs, DAOs, ICOs, like regulators took keen interest in those specific applications. For instance, stablecoins, many of the largest like USDT and USDC, operate on Ethereum. That's right. They're all on Ethereum. So, yeah. So let's just have a moment of silence for that. And that became a focus of regulatory discussions about financial stability and money laundering. And in 2022, a notable incident tested Ethereum's claim to neutrality. The U.S. Treasury's Office of Foreign Assets Control sanctioned the Tornado Cash Mixer contract on Ethereum, and they alleged it was used by hackers and violating sanctions. This put some Ethereum infrastructure providers in a bind. A number of validators, particularly those run by regulated entities, began to filter transactions associated with the sanctioned addresses, raising concerns about censorship on Ethereum. The community responded by emphasizing the importance of decentralization and validators and exploring technical fixes like proposer builder separation to obfuscate transaction contents from. Moving on to 2026, we have Ethereum's base layer remains censorship resistant. Yeah, so what that means is that censorship resistant in that the transactions could still be included eventually, even if some validators censor it. But the episode underscored the perpetual tug of war between open blockchain activity and government oversight. Still on balance, Ethereum found a cautious acceptance in many jurisdictions. The European Investment Bank's decision in 2021 to issue a €100 million digital bond on Ethereum's blockchain was a landmark example of a major public institution directly using Ethereum for a critical financial instrument. That bond issuance, settled with aid of a central bank digital currency experiment by Banque de France, demonstrated the viability of public blockchain for even conservative finance. Around the same time, payment giants also embraced Ethereum in their own way. In March 2021, Visa announced it would begin settling transactions in the USDC stablecoin over Ethereum, essentially using Ethereum as a value transfer rail. And by 2023, PayPal launched its own US dollar stablecoin as an ERC20 token on Ethereum, which is a strong signal that even fintech incumbents saw Ethereum as a core infrastructure for digital money. From big tech to gaming to art, countless industries dipped toes into Ethereum. Nike and Adidas issued NFT collections, Reddit integrated Ethereum based community points, game studios experimented with Ethereum assets, governments like Ukraine leveraged Ethereum to receive global crypto donations during crises. So Ethereum had become not just a blockchain for coders and traders, but a platform that mainstream entities felt that they needed to understand or utilize. Then, by 2026, Ethereum stands as a mature living ecosystem, vastly evolved and transformed from the fledgling network that launched in 2015. Its journey over the past decade plus has been nothing short of epic. We have seen Ethereum reinvent its architecture from proof of work to proof of stake. Whether booms or bust cycles of adoption spawn new industries from ICOs to DeFi to NFTs and scale itself from 20 transactions per second on a single chain to potentially thousands across rollups, all while maintaining uninterrupted operation notability. Notably, Ethereum has never had an unplanned downtime in all these years. Its native asset, Ether, has evolved from a simple fuel for computation into a centerpiece of digital finance, used as collateral around the ecosystem, yielding staking rewards to validators, and even dubbed ultrasound money by fans for its deflationary tendencies post EIP 1559 and merge. So the community behind Ethereum, once just a ragtag bunch of hackers, is now a diverse global collective of core developers, application builders, financial institutions, artists, and users on every continent. Decision making is still rough, consensus driven by open discussions, Ethereum improvement proposals, and social coordination. A unique blend of human and software governance that, despite flaws, has managed to guide Ethereum through numerous contentious changes. Technically, Ethereum's base layer is leaner and stronger, with state management improvements on the horizon, like vertical trees, the slimmed down node requirements, and the prospect of full sharding. Still plan to increase data availability even more. The core protocol continues to evolve. As of 2026, Ethereum is on the cusp of another upgrade to integrate vertical proofs and other changes, pushing it closer to the vision of a highly scalable, light nodes friendly network. If Ethereum's first decade was about proving that a decentralized world conquer could be built, the next decade is poised to make it fade into the background, to become an invisible yet ubiquitous public utility, rather like the internet itself. So, looking back, the history of Ethereum is a chronicle of adaptive evolution. Time and again, real world challenges forced Ethereum's hand to innovate. The DAO hack led to better security practices. The ICO bubble and CryptoKitties congestion pushed forward scaling strategies. The DeFi boom underscored the need for layer 2 and cemented Ethereum as a financial substrate. The merge showcased radical technical bravery to secure sustainability. The roll up revolution transformed Ethereum into a multi layered network. Through each phase, the community learned and iterated. Ethereum's core philosophy, to be a general purpose platform for decentralized applications, has remained intact since Vitalik's original white paper. But the implementation of that idea has changed dramatically with accumulated wisdom. One key lesson has been the power of incremental open source development in a live environment. Ethereum shipped early and learned from failures. As some have noted, building security and scalability in public, step by step. Another lesson is that modularity is essential for scaling an open system. Rather than one monolithic chain trying to do everything, Ethereum embraced a more complex but more scalable stack. Layer 1 plus Layer 2 off-chain components. A necessity, not just a training design, and hand in hand with technical progress. Governance had to evolve from informal chats to more structured community proposals, from simple coin voting to emerging cross domain governance, highlighting that decentralization is as much a social challenge as a technical one. From its genesis, in a young programmer's vision, aka Vitalik, Buterin, Ethereum grew into a global public utility, a decentralized world computer carrying billions of dollars in value and untold social and creative significance. It enabled entirely new forms of economic organization. People can coordinate trustlessly across the world with tokens and smart contracts. Developers can launch applications that no one can arbitrarily shut down. Artists can issue digital art that provably belongs to someone. Communities can spin up their own currencies or governance structures overnight. By 2026, Ethereum is deeply interwoven with the broader quest for Web3, an internet where users, not central companies, own their data and digital lives. Of course, challenges remain. Scaling is an ongoing journey. User experience is still being refined. Wallet management, key security, and regulatory uncertainties linger on the horizon. Competition exists too. Other smart contract platforms have risen, some faster and more specialized, but none have dethroned Ethereum's unique amalgam of first mover ecosystem. Developer mindshare and relentless innovation. The story of Ethereum thus far is one of vision meeting reality again and again, forging a technology that was once dismissed as impractical into something indispensable. And remarkably, throughout all these changes, the network's core ethos of decentralization, openness, and innovation has endured. Ethereum's history is still young, just over a decade since conception, yet it already reads like a dense epic, full of twists, crises, and breakthroughs. As we stand in 2026, the foundation of the world computer is built and solid. What remains is to continue scaling it, governing it, and applying it to humanity's ever-expanding digital ambitions. Ethereum's past gives confidence that it will rise to those future challenges, guided by the same collaborative spirit and technological ingenuity that brought it this far. The world computer is very much alive and its narrative is still unfolding, an open-ended story of code and community transforming how we transact, interact, and trust on a global scale.